Alrighty, everybody. I'm just going to go over some spread trading ideas. This is going to be for the rest of the week. So down here at the bottom, in the blue we have the NASDAQ, in the yellow we have the ES, and in the green we have the YM. This is, on the bottom chart, this is a percentage-based chart. So all three of these indexes are on an even playing field because it's on a percentage. As you can see over here to the right, it's on a percentage based. So this is 3 months. So this is just a percentage that it has moved. As you can see right here, this starts out on the very far left at 0, and then today NASDAQ is still at negative 2.7% as far as for 3 months, and ES is negative 14% for 3 months. Now the top chart, this I have at a 5-minute interval, and this is on a price action based. So over here on the left we have the YM, and then over here we have the ES and then the NASDAQ. So what I'm looking at is I look at a long term, and then I go to shorter term to try to get some quick trades. I might make a trade that day and get out that day, or I might have to hold it for a couple of days or even a week. So what I'm looking at here is a lot of times with spread trading, you're hedging yourself. You're buying one index and then you're selling the other. So you're not just one directional trading. And this type of trading, a lot of hedge funds do it. So, and I've been doing this for a while, so I just want to go over some ideas, and also in future videos I'm going to be going over more in detail of actually how to do this and actually educate people on how to do spread trading with the indexes, as well as doing some counter spreads for like the commodities market for like oil and soybeans and things like that. But right here, these are the indexes, and this one, the NASDAQ, is higher valued right now than the ES and the YM. So for me, I'm going to be looking to go short the NASDAQ and long the ES because the NASDAQ is higher than the ES. And this is on a percentage based chart. So then, now that I know what direction I'm going to be going, then I go into this chart here, the top chart. So let me go ahead and blow that up. And as you can see here, let me take off the YM so we can take a look at this. Now here on the 16th, as you can see here, they spread apart. Now, these three indexes are highly correlated, so they kind of follow each other. Sometimes they get out of the whack and then they come back together. And that's what spread trading is all about. And I'm going to be going into future videos and teaching that more in detail. But this, I just wanted to show people, get the idea out there of how you can do spread trading, and you're basically hedging yourself. So you really don't care what direction the market goes up or down, because you're looking at these correlations to break down. As you can see here, these markets are correlated. As you can see here, they kind of broke down, then they came back together. So right here, the NASDAQ is higher than ES, and we looked at it long term, the NASDAQ was higher than ES. So once this correlation breaks down high enough, and this could have been news, it could have been earnings, it could have been anything, or it could have just been traders just pushing the market and the NASDAQ runs up. So what I would do is, let's take one contract for instance. I would sell one contract of the NASDAQ and buy one contract of the ES. That's because I'm doing one-to-one because of the notional value of these. Now I'll go into that a little bit further. So if you were trading the Russell, then the notional value would be different. I usually not trade the Russell. I just stick with these three indexes when I do spread trading for the indexes. So as you can see here, they were kind of trading along, and then all of a sudden it broke down. Now it broke down pretty substantially because this right here on the ES, as you can see, this is 10-point move, and that's another 10-point move. So if we look at this, and let's just draw, I kind of look for a 20-point move, just roughly. It doesn't have to be exact. I just kind of look for a 20-point move, and that right there meets the criteria. So I start looking in to get in. So I might go in one contract. I will sell the NASDAQ, buy the ES. Now, as the day goes by, because that would be around like in the afternoon. So those two did not come back together by the end of the day. But as you can see here on the 17th, they came back and they were correlated again, because correlation here broke down, then it came back. Okay, and throughout the whole day they came back, and then actually if you go in two contracts, you take one off and then look at that. They actually spread apart. They went in the opposite direction that did the previous day. So you would take off all your money. But I don't look for that. I just look to try to get some quick profits and just build an account slowly. So that's just an idea. That was the past. And like right here I wouldn't take the trade. And the reason for that is because right here, you're selling the ES and buying the NASDAQ. Yes, they came back together, and yes, you would have made money. But I kind of look at the long term. I want to be in the direction of the long term. The NASDAQ is overvalued. The ES is undervalued. So if I was going to look to do anything, short the NASDAQ, long the ES. So as you can see right here, on this trade, you would do that probably around 7 o'clock in the morning, about 8 o'clock. So you would sell the NASDAQ and you would buy the ES, because this right here, if we look at it, that's just roughly, that's within in like a 20-point range for the ES. So that kind of broke down, and I just go off of 20. Just because it kind of gives me a good idea. After a while, you can just kind of eyeball it and get in. So you would sell the NASDAQ, buy the ES, and then look what happens. They come back together, and then you just close out and you take your profits. Now here's the thing. Right here, because the notional values would be the same, one-to-one contract. So you're selling one NASDAQ, you're buying one ES, because correlation broke down. So unless right here they came back together, you would make a profit, because you would be making a profit on the NASDAQ. You would be losing money on the ES, because NASDAQ, you're shorting it, it went down, you made money. ES, you went long, but you lost money. So the difference is your profit. And I'll go into that a little bit more detailed in the future. So this is just spread trading. You're just hedging yourself. Like right here, you don't care if the market goes up or down, as long as you keep the notional values correct. And when they come back together again, that's when you make your money. Now, right here was a nice spread, and it could have even broken down even further. That's when you go in on a second trade. I kind of do this in 3 stages, 1, 2, 3. Most of the time I'll just get in and then I'll just get out, take a quick profit. So, and this happens, if it happens 1 time a week, that's great. If it happens 2, 3 times a month, that's great. You just sit here and you just look for it, and then you can get in and you start building an account up. So this is what I'm looking for. This I'm not going to get in, because it's only like a 10-point spread. I'm looking for it to get 20 points away from each other for me to get in, like it did back in here. So will it happen like Thursday or Friday? May not. Next week, is it going to happen? May not. But I'm just going to sit here and wait and see what happens. See, like right here, you could have got in. So the NASDAQ by the ES. The next day, you would still be holding it. And then the day after that, you kind of take it off for a profit right up here. So, and this happens all the time. Are you going to be making more money if you just go one directional? Yes, but it's a higher risk. So with me, I've been trading for, I don't know, I've been trading for over 15 years. I've blown up accounts and I've lost money. So, and do you make mistakes? Sure, you always make mistakes, but I've just learned, because I've been trained from an individual that worked at a hedge fund, and this is a awesome way to trade, and I would love to teach people how to do this. So this is not the Holy Grail, never even found the Holy Grail, and yes, I did look for it. So, but what I'm looking to do is sell the NASDAQ, buy the ES. I'm waiting for this correlation to break down even more, so then I can get in, and then we'll go from there. And then when they come back together, take your money off and make a small profit. That's all I have. In the future, I'm going to go over in more detail about this. I would highly recommend, if you're trading futures, go to the CME group site, understand what you're trading. And if you want to get into this type of trading, highly recommend the paper trade. And also with the micros for the ES, NASDAQ, and YM and Russell, the micros is a fantastic way to learn, because you're not risking a whole, it's a tenth the amount of the bigger contracts. So that's all I have for tonight, and I will create another video later. I will talk to you at another time. Have a good evening. Goodbye.